Markets are knocking on all-time highs, but something big just changed. The corporate buyback blackout started today, and it could be a major drag on this rally. Plus, options market mechanics might start freezing prices in place. Let's break down what's really going on and what it means for your next move. Let's dive into these markets. So starting off here, the S&P 500, dramatic reversal. Obviously, we had a big down day on Friday. Everyone was worried that that was the beginning of a new downdraft. And today, markets are pressing that if they close here, it would be a multi-month high. Very fast reversal. I don't want to try to pinpoint a news variable for it. All I can say is that the primary trend is still quite intact. That entire pullback on Friday didn't test any real critical fib zones. I mean, it approached the 50% retracement of its last rise. The 50-day moving average is still well below it. The sequence of higher highs and higher lows is intact. So the bulls continue to press towards completing this measured move, irrespective of geopolitics, which is a double top retest, very close to the 6150 on these S&P futures. And so right now, the path of least resistance is the market still to hammer into these resistance. Now, as much as that resistance is a short-term upper target, the real interesting thing that will be is whether or not the 5900 gamma pin kicks in every day we approach towards the end of the month. So June 30th is the option expiration for this huge options positioning of short calls or dealers long a whole series of calls from this collar that was built by JP Morgan. Bottom line, it's close to $25 billion of notional exposure, and dealers need to hedge this as the market progresses higher, which naturally acts as a resistance right into previous highs. So my view still remains that this is going to be a formidable overhead resistance, and there's very little benefit in chasing this market up into these highs unless you're a day trader. Now, at some point we'll get a correction, but odds are that for the next few weeks, this market is more likely than not boring, in spite of getting some big kind of headline prints and anticipation of the FOMC. At this moment, expecting the market to first grind it out a little bit for a few more weeks is the path of least resistance, or at least I would assign the highest probability to. Now, we do have the blackouts starting, corporate blackouts for earnings season. So some of that tailwind buying is no longer going to be there. There's increased insider selling in the markets, and we're reaching a lot of exhaustion points in this market. So it just really reinforces all of that together, which is that while the trend is up and certainly the next few days can be up, it's not an easy and asymmetric trade to be long this market here. But maybe a quick 200 S&P point drop below 5,900 could have us quickly buy a short-term dip for a return back up to the highs into the first weeks of July. Moving on, let's look at this US dollar. So we have a US dollar that is still declining, even temporarily broke to a lower low. I mean, it is still a very weak chart. We were speculating that these lows at 98 were likely to hold, but we do want to highlight that this measured move down to 95 is still the technical measured move, right? So we had a Fibonacci retrace, test of the 50-day, and a symmetrical move heading down to that. So while I've been speculating that it doesn't break down that low, that's going against what is the technical typical move that we would see. At this stage, the dollar weakness continues to prevail. We're still speculating as to whether or not this can fade back towards that 50-day moving average or higher, but that's not in a bull trend, but rather in a trade range, coming to the top end of its ranges. And so we're going to watch to see whether the dollar stabilizes here, but no immediate trade opportunity in there. So let's move on to some of the other markets. Let's first touch on the precious metals. Now, gold down $17, but it did break to a higher high, and it is still in bull trend. And this pullback is not anything out of the ordinary of a typical retracement. We have a clear bull breakout, and I would continue to assume that this can continue. Now, could it be a double top testing previous highs? There's always a chance, but I think there would need to be a macro catalyst to really derail this move in gold that really is got its own momentum and getting fully underway. Crude oil had a big pop and drop over the weekend as well, and back up to that $76-$77 area, now fading all the way back to 71. We continue to see the oil markets obviously reacting to geopolitical escalations, but really there is almost no benefit at this point in my mind in doing a brand new buy here until we see how the oil prices settle in. And so at this stage, it's been a nice trade. Things are in there. We're taking a little bit of profits and just now at this point going to let it settle in. The bigger question is this change the sentiment towards many energy companies? And that is a bigger puzzle to solve, as we're going to want to see whether or not a new bull trend could potentially get underway in that area where many of these stocks that have been really left behind and have not participated in the last little while, and maybe a sector rotation may get underway, profit taking some overbought areas and chasing what is now been sort of left behind, and now can potentially catch up. Just a quick note on platinum and palladium. They still are very bullish. Now we've seen some reversal candles coming in here as they've paused this bull advance, but they should all be bought on dip at this stage. These are new bull breakouts. They're still early innings, and I don't see any reason why one should assume that it's all over and going to mean revert. And so we'll be watching for all of these buys throughout the week as to where these continuation patterns are going to set up from. Uranium's been very quiet. Nothing really to say there. I mean, overall, uranium has been bullishly behaving itself from a U308 perspective, but it continues to be a massive divergence as the uranium companies continue to be incredibly hot, and uranium itself hasn't caught up yet. I still generally am quite bullish all of it. It's at this stage, though the action isn't in the U308 contracts and the physical trust units that own them, at least not yet. Just turning on treasury bonds, I wanted to simply highlight this is the long bond. I mean, it has put together a couple days of strength last week to try to get it back above that 50-day moving average, but I still don't feel that that's enough to turn bullish. Notice here that everything has failed at the Fibonacci zones. Even a close above the 50-day was quickly faded. There is still a primary downtrend that hasn't been broken. And so at this, while I'm not eager to want to be short these bonds, I certainly am not interested in calling a bullish play on them just yet. There's a lot of chaos that can still happen here in the long bond, and to be honest, it continues to be an area where I feel it could create a very fast stress point. If we had 30-year yields breaking out to a decade high, suddenly it's going to get talked about and may potentially spook the markets at a time when right now no one seems that worried.